There's a lot of news flow from China, most notably around property developers and property investment companies, but also in the form of what is perceived as interference in the markets in tech companies like Alibaba, Tencent, and Ant Group. But what about the market? And does it provide us here in the West with good quality investment opportunities? Well, Brendan Ahern joins us now from Kraneshares. Brendan, welcome.
Thanks for having me, John.
IG has a number of Kraneshares funds on its platform, on its investment platform, which investors can access. Yep. But before we get into that and talk a little bit about the value in the Chinese markets, just explain the Chinese markets if you can, because from where I sit, I don't get the feel that there's much transparency. So if you can just decode what the Chinese markets present to us as an investor in that market.
Well, I mean, and this year, that definition of what is China has never been more important because of a very significant disparity between the performance of Chinese stocks based on where they're listed. So you have the Shanghai and Shenzhen, which often are termed the A-share market. That market is 95% owned by investors in China. And it's very much reflective of what Chinese investors think about China. And just using our ETFs as proxies, KA50 and KSTR, you'll notice that those markets are actually up a little bit this year to date. Not significant outperformance, but they're actually positive year to date. And we can contrast that with the historical foreign definition of China, which is really Hong Kong and US listed companies. And there, if one's definition is, say, the Hang Seng Index, you're down over 10%. For the internet companies via, say, KWEB, which tend to be Hong Kong and US listed, you're down upwards of 30% year to date. So again, that's driven by the disparate view of what foreigners think about China, and we can contrast that to the A-share market, which is really what the Chinese think about the Chinese market.
Before we get into investment opportunities again, I just want to quickly touch on liquidity. What's that like?
So the A-share market, so Shanghai, Shenzhen, by market cap is the second largest stock market in the world. And if you look at the securities in terms of the most heavily traded, very, very liquid, particularly in the large cap, mega cap names. These securities are trading millions of shares a day worth hundreds of millions of dollars. So very much similar to what you would see, say, on the London Stock Exchange in terms of the most heavily traded securities. Very big liquid names in the A-share market. Very similar situation if you look at, say, Tencent listed on the Hong Kong Stock Exchange or Alibaba listed on the New York Stock Exchange.
As I said at the top, for us here in the West that consume the news that comes out of China, we quite often hear the property sector in a negative way. And as I said as well, as to what's happening with what is perceived as an interference in the tech sector. What is the Chinese market like at the moment? We are also hearing a little bit about the slowdown in the Chinese economy. From a Westerner's point of view, a good market to approach and look at?
Well, again, it goes a little bit back to what the Chinese think about what's happening in China is very different from what we in the West consume. That if you read the Financial Times or the Wall Street Journal or Bloomberg or Reuters on a daily basis, you tend to have a bit of a negative narrative. And it's not that investors in China aren't aware of that news. They don't necessarily buy into it, that they see the Chinese economy, which has come out of its quarantine Q1 2020 quite strong. The global reopening is a good thing for China as really the world's factory, as the world comes back online. That's going to be a good thing for China's economy. So investors in China have been much more constructive on the Chinese economy, and therefore that should be good for Chinese stocks. And there's issues around internet regulation and say the Evergrande, the real estate situation, which again, they're aware of, but they're actually less concerned about.
I was interested actually in one of the quotes you had of President Xi in one of your recent papers. You quote President Xi as saying, "Housing is for living and not for speculation." How far speculation goes down the road of investing, I'm not so sure. But as credible as this may be, it doesn't sound like an invitation to invest. Is that a misperception? Do you think the property market in China is still investable? Or are there a lot of unanswered questions about the future and the liquidity of that business? What should we know about what's happening with Evergrande and other property companies?
So the real estate situation in China is unique that investors in Chinese real estate have never lost money. That Chinese cities, due to continued urbanization, just keep getting bigger and bigger. So if you know the cities are going to get bigger, you've always made money. And now that's a problem because 40 to 60% of Chinese wealth is actually in apartment buildings. And the Chinese policymakers don't want to see more capital. What China really needs are semiconductors. They need the technologies that will lead China in the years and decades to come. So they're trying to disincentivize real estate investing. And that's flowed through to trying to slow down the debt, the growth of debt in China. That we've seen debt in China really level off because they've tried to identify who's leveraging themselves up. And a few years ago, they focused on state-owned enterprises. And last year, they pivoted to real estate companies. And that's where policy has actually created the Evergrande situation.
Rightly or wrongly, in the West here, when we had the financial crisis 10, 12 years ago, central governments and central banks stepped in, didn't they, to support the banking market, knowing what damage it would do to all of us individuals and to corporates pretty much around the world. Why doesn't China do that of Evergrande? Why doesn't it? It has the capacity, I understand, to step in, and it could actually be, we're talking $300 billion in debt, but it could step in to clear all this. Why does it not do so?
They don't want to incentivize poor corporate governance, poor corporate management. If you simply bail out Evergrande, that means you'll deal with some different variant down the road. Now, Evergrande in the West is considered China's Lehman moment. I would argue it's more like their Bear Stearns moment, because without Bear Stearns going down, there is no Lehman. So Evergrande, they can't let it flat out default, to outright fail. But they don't want to create more Evergrande. So what will happen is similar to what the ECB did with Greece. You extend the debt, you lower the interest payments, and you allow the company to muddle through. So Evergrande is going to finish all of its projects. They will pay back the debt. The government will force its creditors to take a haircut. And the bonds are reflecting that. They're reflecting a restructuring. But they don't want to see it default because, A, you have people who have paid Evergrande for an apartment that hasn't been built. You have the people who funded that project. And then you have the construction ecosystem, construction companies, electricians, plumbers, the people running the cement mixers on dozens and dozens of projects across China for Evergrande. You want to see all those people made whole. And that's why Evergrande will muddle through, but an outright default is considered in China highly, highly unlikely.
What effect is this having in terms of contagion within the Chinese economy? As I said, we're talking big numbers here. And Evergrande, I think, is the biggest of its type. Am I right in saying
it's become the second largest, really driven by its willingness to take on debt, to go national. So it's a national real estate company. And that's made it very problematic because Evergrande does represent a systematic threat. You know, that if they fail, it could create a financial crisis. And policymakers in China tend to be very proactive, as opposed to Western policymakers tend to be reactive to crises. So they're trying to head this off at the proverbial pass.
Is there an effect in the Chinese economy from this? I mean, I guess, at some point, people are going to think, hang on a minute, this is not the right way to structure business. We're going to row in on some of our debt, possibly, maybe. Do you see this as having an effect on other areas of the Chinese economy?
Well, I think they certainly want to see real estate come back from its prominence within the economy, that you have so much savings and that you have so much, about 20% of GDP is really infrastructure, property geared. So they don't want more cement blocks. They want technology. They want semiconductor chips. They want biotech and healthcare. Clean energy. They want to see capital being directed to those areas of the economy, as opposed to this always winning trade in real estate. So they can't allow real estate to crash. It would hurt consumer confidence, but they need to slowly wean investors away from the space.
And as I said earlier on, there is this perception that this is where the news headlines are in China. Do you think us in the West have had our perceptions and our investment intentions redirected because of Evergrande? Do you think that's having an effect in the West? Should we be more aware and should we be more wary of investing in China because of Evergrande?
Well, I think a lot of times what we believe Western media sometimes misses is, in finance, everything we do is supposed to be data driven. Mm-hmm. And if we simply look at the data as opposed to the sensationalism, the hyperbole, the apocalypse now mentality of the media, we find a very different situation. And it's very interesting right now. The narrative around the supply chain crisis has changed. It was, this is a China, this is an Asia problem. But as people actually did the work, they were like, no, this is about ports. That U.S. ports don't operate 24/7, and the boats are out in the harbor. They just can't unload them due to regulation, lack of warehouse space. Drivers can only work so many hours. That was, that narrative that this was a supply chain China problem. When you look at the data, the facts, it dispels that narrative. And that's at Kraneshares, we're trying to provide investors with that balanced, fact-based driven analysis, just as we do in all other parts of finance.
It's an interesting point, actually. Let me just very quickly ask you about the political relationship with Xi's government and the rest of the world. I mean, we've had, I think, a meeting recently between Biden and Xi, haven't we? Which I don't know what the outcome of that was deep down, but it did make some headlines. Is there a political willingness, do you think, to work with each other, the big nations, and so us in the West, other European markets follow on behind? Do you think there's a willingness for the Chinese to?
I think so. I think so. And it takes two to tango. Yeah. So communication and dialogue is key. In the U.S., there's a university called Thunderbird University, and they have a great motto. It's a business school, and it says, countries that do trade with one another don't need border guards. And what's interesting is politically, the situation is not very healthy. Economically, the U.S. and China have never been more intertwined. The U.S. and Europe, China and Taiwan, the trade levels have never been higher. China and Australia, very high levels of trade. The politicians don't really get along, but business people seem to be getting along just merrily. And so, ultimately, U.S. companies generate $376 billion worth of revenue in China. Look at Apple's earnings. Their China revenue doubled from $7 billion to $14 billion in the latest quarter. The fastest growing geographic segment for Apple was actually China. And there's that's not just, it's Boeing, it's Starbucks, it's Nike, but it's European companies as well are really benefiting from China's domestic consumption story. Hopefully the politicians can take a page from the business world.
I always think of money and capital a bit like water. It gets everywhere where you allow it to go. And that's the thing, isn't it? Allowing it to go and allowing the discussion to be at a personal level to make sure that we can trade together. But on that subject, tech, it seems to me as though China's putting a brake on capital within tech. For whatever reason, we have actually spoken about this on another interview earlier with another colleague of yours. But I just wanted to get your thoughts on where we are now. We haven't heard quite so much about it, but we do know that we haven't heard an awful lot from Jack Ma, some of the big personalities in the business. I think there was a stage managed press opportunity a few weeks ago, but we haven't heard much from him. And some of the other tech companies, you mentioned Tencent, Alibaba certainly, Ant Group never made it to the market in that big IPO that was promised us. And these sort of events have us in the West salivating over the opportunities of an IPO like this. And then all of a sudden, China steps in, puts the brakes on and says no. Why?
So Ant Group is known for its mobile payments as well as its fintech unit, which is really doing loans to consumers. And China was going through a process leading up to the Ant Group IPO of saying, by calling yourself a fintech company, you do a lot of things banks do. but you're not regulated like a bank. And Ant Group's IPO prospectus was filled with pre-regulatory financial data. And so the Chinese regulators said, isn't it somewhat misleading that you're trying to push this IPO out in advance of regulation, where you're going to have to hold 30% of the loans you originate, just like the banks do, not lend to college students, only lend 200,000 RMB to any individual. That's going to change the financials in your IPO prospectus. And if we allow you to go public, then this regulation comes down, your margins will compress a little bit, your net income, your EPS will go down. So they stopped the IPO. They said, don't do the IPO in advance of the regulation. And they could stop that IPO because it was in Hong Kong. Contrast that with Didi, which went public in the US. Yeah. They couldn't stop it. And so Didi goes public 48 hours later. It falls under regulatory purview, and the stock, unfortunately fell. So exactly why Didi fell is why they stopped Ant. But Ant they could stop, Didi they couldn't.
So in the West, should we be wary of investing in techs based in China?
Well, we think part of the issue that's really weighed on the space, and if you look at KWEB as an example of what the individual securities is, that again, from a Western perspective, we view China as this singular entity. And for weeks, over the spring and summer, we had a new negative event. If it was Baidu or Meituan or Didi, and 10-cent music. And it felt like this ad hoc, almost whack-a-mole situation of new regulations every week. In reality, what's happening is you have a fintech regulation. You have user data, user protection, anti-monopoly, anti-competitive. And those different silos are being driven by different regulators moving at different speeds. And that's why, as an outsider, it felt like, oh my gosh, every week it's something new. But it was actually different regulators moving at these different speeds and these different silos. But we do think that it's very likely that the worst is behind us. In Tencent's Q3 earnings call, they said the regulation, user data, user protection laws in effect September 1st, November 1st. If the laws are in place, aren't we adhering to it? It might mean there might be tweaks to it, but we do think hopefully the worst of this is behind us, and the fundamentals of the companies have been quite strong. That's been the hard thing, is the price action doesn't agree with that statement, but the fundamentals of the companies have been quite well. They're not being hurt by the regulation. They're adhering and adopting to it, and they're buying back their stock, which is a great sign that they're big believers that the stocks are cheap.
One of the other things I just wanted to quickly touch on was the MSCI and its inclusion of A-shares. In the past, it's done this, hasn't it, through a couple of reviews, I think. Is that right? And we've seen A-shares come onto the MSCI. That's right, isn't it? So,
correct, yeah.
Are we expecting any more from MSCI to include more A-shares in the offering for the MSCI indices? So,
MSCI's Global Investable Market Index methodology dictates 15 trillion of active and passive assets. And MSCI, starting in 2019 and 2018, 2019, was adding large cap and mid cap stocks to their definition of China. And that flows through to emerging markets, all country world. But what's interesting is they only added, of the nearly 500 names, they only added 20% of their market cap. So the A shares within MSCI emerging markets, over 700 of the 14 names are Chinese names. Right. The A shares represent only about 5% of MSCI EM. But to raise that inclusion factor, to get where these securities will represent 20% of EM alone in the A share market, is they wanted a futures. They want China to move away from T+0 trading and alignment of Hong Kong and mainland market holidays. And a few weeks ago, one of those boxes got checked, that MSCI listed a MSCI China A50 futures on the Hong Kong Stock Exchange. So we think that checks one of the boxes MSCI needs. They need China to slow down in terms of this T+0 settlement. And then they want to see these holidays be aligned. But we think that it's very likely that, or potentially, MSCI will enter a consultation where they go on and talk to their clients. That might get announced next spring. We'll fingers crossed about that event. We'll keep you informed, Jeremy.
Let's wrap it up and just get the crystal ball out and talk about 2022. How do you feel, as someone that covers the Chinese markets, about next year? And as I said, from an investor point of view, what's it looking like?
Well, I think Chinese economy, they're willing to recognize that they want healthy, slower growth as opposed to debt-driven high levels of growth. I think for investors, you're going to see a lot of emphasis placed on these technologies that China needs. Really a lot of the things where we're invested in the STAR board, the KSTR ETF, because it's really comprised of the industries China needs more of: semiconductors, biotech, AI, cloud, etc. At the same time, I think what we need in terms of the KWEB, the internet e-commerce companies, is you need investors to have confidence that the worst of this regulatory environment is behind us, and the valuations on these companies, PEG ratios below 1, historical valuation is like a 2 standard deviation event. On a relative valuation basis, very, very inexpensive compared to European, US internet equivalents. We need investor confidence to come back into these names, and it makes us very constructive for 2022 and beyond.
Well, look forward to that. We'll have you back in the studio.
I'm looking forward to it,
sometimes
Jeremy.
in 2022. It's great to see you, Brendan.
Yeah, likewise, likewise.
It's good to be able to catch up with you. And what's happening in China? That's Brendan Ahern from Kraneshares. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.